Welcome, and thank you for joining today's webinar hosted by Trustworthy, the creator of the Family Operating System, which protects all of your information in one place. I'm Don Kirkpatrick, Trustworthy's Head of Content Strategy, and I'm here today with Kyra Amani, Trustworthy's Head of Customer Success, and our special guest, Janet Berry Johnson. Janet is a CPA with nearly 20 years of experience helping individuals, families, and small businesses with their taxes. I'm going to give a minute here to let Janet and Cairo say a little bit more about themselves and what they do, and then we'll go into a Q&A with Janet, who will share last-minute strategies to get your taxes done right and to avoid costly mistakes. Go ahead, Janet.
Thank you, Don. As Don mentioned, I'm Janet Berry Johnson. I'm a CPA, and I'm also a daily money manager. That means I help families look after their aging loved ones' finances so they don't have to worry about things like unpaid bills or tax problems. And being a trustworthy certified expert fits just perfectly with that because a lot of my clients are looking for ways to organize their important paperwork and share it securely with the people that need it. And when they don't have time to get their paperwork organized and trustworthy, I take that step off their hands.
Thank you, Janet. Cairo.
And I'm Cairo. Like Don said, I am head of customer success here at Trustworthy, which means I am helping all of our customers get up and running with the product. I also manage our Trustworthy Certified Experts team, which I will talk about a little bit later, but they are also here to help our customers when they need an extra hand. And Janet is one of our lovely team.
Thank you. We're going to be covering these topics today and some questions with Janet. And audience members are welcome to add their own questions by clicking the chat button on their screen. And we'll get to as many of those questions as we can a little bit later during this webinar. So let's get started with Janet. And Janet, the first question is, many people miss out on deductions and credits that could reduce their tax bill. What are some of the most overlooked deductions that taxpayers should be double checking before they file their taxes?
Yeah, that's a great question. It can get really overwhelming because the kinds of deductions and credits you can claim really depend on your situation. It's going to be different if you own a business, if you have kids, if you're a homeowner, if you're retired. So there's a few things that I see people miss a lot. One of them is contributing to a 529 plan. A 529 plan is a way to save for college, and you can put money in the account and the money grows in the account tax-free. And as long as you use it for educational expenses, it's also tax-free withdrawals. Where it becomes confusing for people is there's no federal tax benefit to the contributions you make, but many states offer a tax deduction or a credit on your state income tax return. The rules really depend a lot on where you live. And in some states, you have to contribute to your state-sponsored plan. So for example, I live in Nebraska, so taxpayers here have to contribute to the Nebraska state plan in order to get a deduction. But I used to live in Arizona, and in Arizona, you can contribute to a plan in any state and get the tax deduction. It's really worth working with a tax advisor who understands the laws in your state, so you can take advantage of that if you're saving for college. Another area that I see people miss out on a lot is if they're self-employed, they might be paying for their own health insurance or contributing to a retirement account like a traditional IRA or a SEP IRA. Now, those contributions can be tax deductible, but there are a lot of rules around claiming them. So if you have maybe a full-time job or your spouse has a full-time job and you have access to health insurance through work, you might not be able to deduct those premiums.
Thank you, Janet. Another area that's a common point of confusion is the home office deduction, especially with so many people working from home these days. Can you talk about who qualifies for it and what are the biggest misconceptions about claiming it?
Yeah, so the home office deduction lets you claim a portion of your home expenses like your mortgage interest or rent, your utilities, your homeowner's insurance, and things like that. Now, where it gets confusing is that prior to the Tax Cuts and Jobs Act of 2017, basically anyone with a qualifying home office could claim the deduction. But that changed. Now it's only available to either self-employed people or business owners. So if you're a W-2 employee and you work for somebody else, even if you're required to work from home, you cannot claim the deduction anymore. Now, if you are able to claim the deduction, you have to use the space regularly and exclusively for work. So it doesn't necessarily have to be a separate room in the house. Like if you have a desk set up in the corner of your living room, you can claim the deduction just on that space. But If you do claim it, there's two ways to go about that. So the first option is the regular method. So this involves tracking all of your expenses throughout the year, your utilities, your rent, mortgage payments, insurance, and then multiplying that by the percentage of your square footage. That's the percentage of your home square footage allocated to the office. So for example, if you have $2,000 of expenses and you use 10% of your home's total square footage for your home office, your deduction would be $200. If you like to minimize paperwork, there's an easier way to go about it, and that's the simplified method. So instead of tracking all of those expenses, you just simply deduct $5 per square foot, up to 300 square feet. So if you have a 100 square foot office times $5 per square foot, that's a $500 deduction.
That's great information. Thank you. Another area that people wonder about is moving expenses. These used to be deductible for most people, but that's changed over the years, right? So who can still claim this deduction?
It used to be that anyone could deduct moving expenses if they moved and their new work location was at least a certain distance away from their former home. That also changed with the Tax Cuts and Jobs Act. Currently, only active duty military members who move due to a qualifying order are allowed to claim their moving expenses. Civilian taxpayers can't claim them at all. Now, if you are military and you have a qualifying move, you can deduct things like the cost of actually moving your household goods and furniture, your travel expenses, lodging during the move, and storing your property.
Okay. Thank you. Another area is mileage deductions. Those can add up, but tracking those can be a real challenge. If somebody hasn't kept a mileage log over the year, is there a way to reconstruct their business or medical or charitable miles?
Yeah, definitely. Just to reiterate, the best way to track your mileage is really to keep a mileage log throughout the year. You can either do that with a paper log in your glove compartment or use an app. There's several apps now and even some accounting software platforms have apps where every time you drive, it records your mileage, and then you can either mark that trip as a business or personal expense. So that's really helpful. But that said, if you missed your chance of tracking during the year, the IRS does allow you to recreate that record. So what you want to do is get out your calendar, your email, your receipts, and use that information to piece together your travel records. Maybe you went out and bought supplies, you visited a client, you traveled to a conference. You can rebuild that information off of your calendar and other records and then back it up with maybe bank or credit card statements. That's going to confirm that information in case the IRS ever decides to audit your numbers. A lot of people think, well, it's just too much trouble. I'm not going to bother with tracking my mileage, but the deduction can really add up if you travel quite a bit. So for 2024 returns that we're filing right now, the deduction is worth 67 cents per mile if you're traveling for business, and it'll increase to 70 cents per mile in 2025. You can also deduct medical miles. That's traveling to doctor's office, hospitals. That's at 21 cents per mile. And driving for charitable purposes is worth 14 per mile.
Thank you very much. We're going to get into some common tax filing mistakes here. So can you talk about some of the most common mistakes people make when they file their taxes? The type of mistakes that can either prevent you from e-filing or cause delays in processing a return?
Yeah, definitely. Some of the most simple mistakes people make are really very easily avoidable if you just double check a few numbers. One of the most important ones is your Social Security number. You want to double check the number for yourself, your spouse if you're married, and any dependents you might have. If you try to e-file your return and you have a wrong Social Security number in there, the IRS's system is just going to reject that return. You really want to pay close attention when you're entering those numbers. Another issue is if your name on your tax return doesn't exactly match what's on file with the Social Security Administration. Let's say you got married, divorced, or changed your name for another reason during the tax year. When you file your return, you may still need to use your former name if you haven't changed your Social Security card yet. You want to check that closely. Another big area to look at is the bank account and routing number if you're going to have your tax refund direct deposited into your account. If you enter a wrong number in there, the best case scenario is the IRS tries to make the deposit and just bounces back. But if it actually goes to a legitimate account that you don't own, it can take the IRS months to get that sorted out. So you definitely want to pay very close attention when you're entering those numbers. And finally, another big problem I see is either divorced or separated parents who are both trying to claim the same child as a dependent. Let's say you were supposed to claim your child as a dependent this year, but your ex-spouse files first and they claim them. So when you file your tax return, you're going to get a rejection, and it's going to say that a Social Security number for that taxpayer already exists. So at that point, you're not able to electronically file your return unless you take that dependent off. So you'll have to paper file your return, and you're probably going to have to submit some information to the IRS explaining why you're the one that's allowed to claim the dependent. And again, that's another problem that can take the IRS months to sort out. So you definitely want to pay close attention to that and hopefully communicate with your ex about who's claiming the child this year.
Thank you. That can be complicated. Another question I have is, more people are receiving 1099-K forms this year. What should taxpayers know about these?
Yeah, so a 1099-K is a tax form issued by payment platforms like Venmo, PayPal, and Cash App. So it reports all of the business transactions that go through their platform during the year. And it used to be that you had to have either 200 transactions or over $20,000 in transactions on the platform to get a 1099-K. But that actually dropped. So for 2024, the threshold is $5,000 in transactions. And in 2025, it's going to drop even more to $2,500. A lot of small business owners might be getting a 1099-K for the first time this year. So where people can run into trouble is when they use, say, their Venmo for both business and personal purposes. So let's say you're a hairstylist, your customers pay you via Venmo, but you also split a check with friends and your friends reimburse you for dinner through the platform. So Venmo and the other platforms are trying to sort out which transactions are business and which are personal, but it's not always easy and it's not perfect. So you could very well get a 10K at year end that shows both business and personal transactions in there. And some of those are taxable and some aren't. If you receive one, definitely take a look at the number and compare it to your records and see if it's picking up any personal transactions. If it is, reach out to the platform, see if there's an option to get that corrected. If not, and if you can't get it corrected, I really recommend working with a tax advisor. You're going to basically have to report the full amount to the IRS and then back it out and attach an explanation of why you have personal transactions on that 10K. That can be kind of confusing to deal with. So that's a good job for a tax professional.
Thank you. Many people are scrambling to file their taxes at the last minute because they're missing key documents. So what are the best first steps to track down missing W-2s, 1099s, or other tax forms?
If you're missing any information, the best thing you can do, the first thing you should do, is reach out to whoever's issuing that. So if you're missing a W-2, reach out to your employer's HR or payroll department. If you're missing a 1099, say for interest income from your bank, contact your financial institution and see if they can send that to you. Now, today, a lot of those documents are coming either electronically through your email or through maybe the website. Check your email, maybe look in your spam or junk folders because they may send you a secure link to download the form. Or if you're waiting on your bank, you might log into your bank account and look around for tax forms. They're usually available electronically these days.
A related question is, a lot of taxpayers' income information has already been reported to the IRS. Is there a way to double check your information to make sure what you have is accurate against what the IRS already has?
There is, and I really encourage everyone listening today to sign up for an IRS online account. You can do that at irs.gov, and you can do that as an individual, and also you can have a business account if you're a business owner. So you just have to answer a few questions to verify your identity to get that account set up. Now, the reason I recommend it is because the IRS has made a really big effort in the past few years to put more self-service options available. For instance, you can get information from a previously filed tax return. You can check on the status of a refund. You can get copies of IRS notices. And there's just a very long list of things you can do with an IRS online account these days. One of the tools that I'm really excited about that can help out if you're in a situation where you want to know what information the IRS has, there's a thing called a wage and income transcript. This is basically a report of all of the income that has been reported to the IRS on your behalf. It has things like your W-2 from your job, your 1099s, anything like that. Now, it used to be that the wage and income transcripts weren't really available or complete until maybe the end of May, early June. So it really didn't do you very much good if you were trying to file before the April 15th deadline. But the IRS just announced that those transcripts are now going to be available on March 30th. So that can be a big help if you're trying to file by the deadline. Now, I haven't actually seen one yet to see if they're really complete, but if they are, that could be very helpful if you're missing information.
Okay, thank you. April 15th is less than 3 weeks away now. What if somebody realizes they're not going to be ready to file by April 15th? What's their next step?
So it's very easy to file an extension. So an extension gives you an extra 6 months, so basically until October 15th to file your tax return. And it's very easy, and there's 3 ways to do it. So one way is to go to irs.gov and find form 4868. This is the basic printed extension form, print it out and mail it in. Another way that's a little bit easier is if you know you are going to owe money and you need to make a payment, you can go to IRS Direct Pay on their website. This allows you to make a payment directly from your checking account. So if you make a payment through Direct Pay and choose extension as the purpose of making the payment, it will automatically process an extension for you. And then also if you're using DIY tax software or working with a tax pro, then they're probably going to be able to file that extension for you, and sometimes at no extra cost. Now, the thing to know about extensions is it gives you an extra 6 months to file your tax return, but you still have to pay the amount you owe by April 15th. If you owe money and you don't make that payment by April 15th, you're going to owe penalties and interest. It can be kind of tough sometimes to estimate what you owe. I recommend if you're using tax software, just put in as much information as you have and maybe estimate the other information. Say you're missing out on, some business expenses or something like that. Just put in your best guess, and that will give you sort of an idea of what you should pay in. And that'll minimize any penalties or interest you owe. Now, I want to just sort of highlight something that I see people do often that really just makes a bad situation worse. And that's when they know that they're going to owe tax and they can't afford to pay the amount they owe. So they just assume, well, I'm just not going to file the tax return. I'm going to stay off of the IRS's radar. But as we mentioned, the IRS gets copies of, your W-2s and 1099s. So they know you made money and you're probably not going to be able to fly under the radar for too long. So even if you can't afford to pay the full amount you owe, I really recommend just either requesting an extension or just filing the tax return if it's all ready to go, and then paying as much as you can now. Even if that's a small amount, it's going to minimize the interest and penalties you owe. And then after that, you can contact the IRS or go onto irs.gov and set up an installment agreement. This gives you extra time to make monthly payments towards that tax debt. A lot of people are afraid of the IRS. They're afraid of owing money to the IRS, but believe me, the IRS is very used to working with people who can't afford to pay their taxes. If you give them a call, in most cases, I'm sure you're going to find out they're very helpful.
What are some simple ways that taxpayers can keep better track of their documents so they're not scrambling at the last minute next year?
What I recommend for everybody is just creating a dedicated space for saving all of your information as it comes in throughout the year. Now, that can be a physical folder or a digital file. I know later on we're going to talk about how Trustworthy can help people save their tax documents throughout the year. Of course, that's an excellent option because you don't have to worry about where you saved the paper documents. But even if you don't save everything in Trustworthy, there's one kind of record that I really recommend everybody save digitally, and that's receipts. So I know a lot of people get in the habit of just throwing their receipts in a folder or a shoebox and deal with it later. Now, the problem is that a lot of receipts these days are printed on thermal paper and they fade very fast, sometimes within just a few months. So if you save a receipt in March, by next March, when you go to file your tax return, you might find that you can't read that receipt at all, and you might just lose out on that deduction entirely. Even if you don't keep all of your other tax records digitally, I really recommend either taking a photo of your receipts or scanning them in and saving them digitally.
Thank you. Next, I'd like to see if we have any questions from the audience at this point. Cairo, do you have any questions for Janet?
We have a question from Steve about HSAs. So Steve says, I just became aware that HSAs apparently are taxable for California and New Jersey income tax. Can you elaborate? Is income earned in my HSA thus taxable for California? What about withdrawals?
I'll preface this by saying I'm not deeply familiar with California and New Jersey law. My understanding is that HSA distributions are tax-free, even the earnings portion, as long as they're used for qualified health expenses. Now, if there's been a change in California or New Jersey that I'm not aware of, that's a possibility. So I would recommend maybe working with the CPA in those states. They can guide you on that.
Thank you. That was our only question.
Janet, since we have some time right now, I have a couple of additional questions I'd like to ask. At Trustworthy, we have many members who are dealing with helping their elderly parents. Do you have any general advice for people who assist their parents with their taxes?
One difficult part of helping your parents with their taxes can be that you're not really familiar with all their sources of income. They might be receiving Social Security benefits, pensions, investments, and annuities, and you're not sure where all the different pieces of income are coming from. If you don't know where to look, a good place to start is check out last year's tax return. So if they received a tax form from their bank or financial institution last year, chances are they're going to get another one this year. So you can reach out to the financial institution and try to track down those forms. Another place to look is out-of-pocket medical expenses. So many young and healthy people don't itemize deductions because they don't have enough itemized deductions, and especially not out-of-pocket medical expenses, because medical expenses have to be more than 7.5% of your adjusted gross income for you to benefit from itemizing. But if your parents are older, maybe they have some health problems, they're paying for a lot of different things out of pocket, it's worth keeping those receipts and claiming that expense.
Okay, thank you. Are there any last minute steps that someone can still take to reduce what they owe on their 2024 taxes?
Yeah, there are. And the good news with these are all ways to reduce your taxes now and also kind of keep some money in your own pocket. One of them is a traditional IRA. You have until April 15th to make contributions for the 2024 tax year. And for 2024, you can contribute up to $7,000 to an IRA, $8,000 if you're age 50 or older. Now, your ability to deduct that contribution depends on your income and whether you have access to a retirement plan at work, but it's a good place to look. Another one is the health savings account that we mentioned earlier. For 2024, you can contribute up to $4,500 to a self-only HSA or $8,300 for a family. Now, a lot of people confuse HSAs with flexible spending accounts. Those are similar accounts for saving for health expenses, but they're basically an employee benefit. FSAs have use it or lose it rules. So if you don't spend all the money in your account during the year or with a certain grace period after year end, you lose that money. But HSAs don't have any use it or lose it rules. So you can keep that money in your account until you retire if you wanted to. And then if you're self-employed, you can contribute to a SEP IRA. The limit for 2024 is $69,000 or 25% of your compensation. And you have until the date you file your tax return, which if you extend your tax return could be until October 15th to make that contribution. Those are all ways to lower your tax bill, but keeping the money in your own pocket.
Thank you, Janet. Unless we have any questions that have just popped in, Cairo, I will move on to the next segment here. So Janet talked about the ways that you can keep track of your taxes year round, so you're not scrambling every spring. She also mentioned how Trustworthy can help, and Trustworthy can be a big part of the solution. So if you're not yet a member of Trustworthy, you can try it out for free by just visiting trustworthy.com. And if you already have a Trustworthy account, but you haven't worked in it much yet, I'd encourage digging in deeper to see how much it can help you. I'm going to take a couple of minutes to talk about Trustworthy here, and then we'll get back to some questions if anybody else has some other questions. We know that many families struggle to manage an overwhelming amount of information. And in many households, that information is just all over the place. It's in boxes, it's in filing cabinets, it's in email messages somewhere in your inbox. And it can be really hard to find something when you need it. And maybe you haven't noticed, but that information is growing exponentially. And more, it's digital first, it's digital only. On the right side of this slide, for example, is just some of the information that households struggle to keep track of. That's everything from tax returns and related documents to medical directives and insurance details and a whole lot more. So where do you keep all this? How do you share it when you need to? How do you keep it safe? All of those things are challenges for a lot of people. And Trustworthy's goal is to make all of that a lot easier. So being disorganized has real costs too. It costs you time, it costs you money, and it costs you mental energy as well. Studies indicate that the average household spends dozens of hours a year trying to manage their information and squanders over $1,000 a year because it's so hard to manage. And most adults worry about keeping track of all this information. Now, a lot of people use do-it-yourself systems, but what we've seen is that DIY systems consistently fall short. First, having to invent something from scratch is needlessly complicated, and it's easy to forget things. DIY systems require ongoing maintenance, making it harder to stay organized. They lack secure, time-sensitive sharing for advisors and loved ones. And they might be understandable to you, but maybe they're not to your spouse or to other members of your family. So what would happen if something happened to you and somebody else had to figure out what your filing storage system was? And lastly, these DIY systems, they're not built for managing urgent, high-stakes situations. A Trustworthy's family operating system, meanwhile, it's the opposite of a DIY system. With Trustworthy, you're getting bank-level security, protect your information. You're getting a structured system with ready-to-go categories, so nothing is going to get overlooked. It's super easy to get started because you can scan your documents with our mobile app, or you can transfer documents directly from your email inbox. Our autopilot tool automatically extracts your document's important information and puts it in an easy to retrieve format. It's also simple to share information securely with family members and trusted professionals, whether you just need to send a document to your tax preparer or you're scrambling to find health insurance details during an emergency. And it's easy to access all of your information no matter where you are because we have an Android and iOS mobile app. And now, I don't know about you, but trying to read and or update a Google spreadsheet on my phone is not something I want to have to do a lot of. We also have automated reminders, so you won't ever forget to renew your passport or your car license or anything else. And Kyra had mentioned that she was going to talk a little bit more about Trustworthy Certified Experts. And so I'm going to hand off to Kyra now, and will explain how that program works and how it can help you a little bit more.
Thanks, Don. Our Trustworthy Certified Experts team is a group of our partners who own their own businesses like home organization, financial advisors, tax advisors. We even have people who will help you manage moving to a new house, others who specialize in folks who own businesses. We have a lot of support for retirement, end of life, and things like that. We have like a death doula on the team. So essentially, Trustworthy is a tool for a ton of use cases. You might be starting a new family, you might be starting a new business, or you might be preparing to pass on, and you have all of this information that you need to keep organized and safe. And for a lot of our members, it can be overwhelming to get started. So that's a great time to chat with an expert who has a field of expertise that's relevant to the stage you are in your life or like your particular needs. They're all certified for digital organization with Trustworthy in addition to their other services. I also recommend it for someone who just wants some help. So you may not want to do all the work yourself and you'd like to hand it off, or you might just need some guidance on how to get started. And that's where an expert can come in and be handy.
Thank you. And in a moment, I'll show you where you can find Janet and all the other Trustworthy certified experts very easily by visiting Trustworthy. We have a little bit more time now. If there have been any other questions that have come in, Cairo?
Nope, looks like we are still at one.
Okay, so I think that's a good sign, Janet, that the questions were very thorough and answered what people were trying to find out today. At this point, I just want to share Janet's contact information here. This is how you can reach her going forward. And we'll send out a recording of this so you don't have to try to jot down her email address really quickly here. But I want to point out the red arrow here on the right-hand side of this slide. That is our Work with an Expert page. You'll find that at the bottom of every page on Trustworthy. And if you go to that page, you'll be able to find Janet's contact information as well as our other Trustworthy certified experts from there. So very easy to get a hold of Janet if you need some last-minute personalized tax advice. Finally, we'd like to thank Janet for her time today and to thank all of you who attended today's webinar. And in case there's, like I said, we'll send out a recording of this session later in case there's anything you want to follow up on, re-listen to, or if you want to share something with somebody else. And lastly, I just want to say have a good day, everybody, and good luck with April 15th. Thank you.
Thank you.